Dalton Street Capital is unique in the Australian investment landscape. We engineer portfolios for clients based on mathematics, science and rigorous logic. We've been doing this for over 22 years inside investment banks and private family offices. My co-founder Nick Selvaratnam and I started Dalton Street Capital to give retail investors access to this type of institutional grade investment strategy. Well, Nick and I and the other members of the investment team are co-investors in the fund, so we have the same outcomes as our investors. Also, our remuneration is linked to the performance of the fund as well. So the better the fund does, the better our own individual remuneration is. Two of our primary strategies that we run, both a managed futures strategy and our underlying collateral strategy, in normal market conditions are completely uncorrelated. However, when we see extremes of market conditions, and in our terms that means extreme volatility on the upside or extreme volatility on the downside, those two asset classes become negatively correlated. So therefore, if you're only in one asset class or the other, you'd expect a down year, say once every 4 to 5 years. By combining those as a multi-strat strategy, you will find that that's how you can generate the absolute returns, because whilst one is up, the other will be down, and whilst one is down, the other will be up. And normally the returns are asymmetric. So therefore, that gives you the absolute return over time. Our investment strategy is the strategy of a managed futures manager, with some key elements that make us stand apart from the traditional managed futures manager, or CTA as they're known. One of the key elements is we run an equity portfolio as our collateral rather than cash. The second is we take all the leverage off the table at the end of the day, so we're not leveraged overnight. And the final aspect is we use very little leverage. So in our fund, we only use 1 times leverage, where the traditional manager in our space will use many multiples of that to achieve their return. Well, we're a multi-strategy managed futures manager, so our portfolio can change from day to day, because what we're trying to do is achieve short-term returns through the futures portfolio on an intraday basis. So we construct a portfolio at the commencement of the trading day and we deconstruct it at the end of the day. The only way we can do this is through algorithmic trading. So therefore, we don't rely on the traditional inputs that most managers rely on. What we do is we use computer models that we have programmed ourselves, and these generate buy and sell signals during the day for us, and that helps us create the absolute return. The equity portfolio that we run is also selected in a very similar manner. It's selected via algorithms, and it's an output that we rely on the aspects of science and mathematics rather than guessing the next year's earnings. There are many ways to make money in the market, and we've chosen 2 that work in concert with each other. So the long-term returns that we achieve is through our long-term systematic equity portfolio. That's where we've taken long-term fundamentals that we know are performers over time and put those into an algorithmic model. And that's a very low turnover portfolio. Average holding period somewhere around 5 years for us in that portfolio. The short-term side's a little bit different because those traditional long-term fundamentals like PE, dividend yield, earnings yield, don't work on a very short-term basis, particularly ours, where we're only holding these positions for a few hours. What our research has shown, and this goes back many, many years, is that the drivers of short-term returns are more likely to be volatility and liquidity. And they're the main inputs into our short-term algorithm. At Dalton Street, we use maths and science as the core of our investment decision making. And what that means is we're an evidence-based research organisation. So whereby companies and investment managers will look at short-term forward earnings or short-term forward forecasts, we look at long-term backward earnings. So we will look back to the early 1930s to test our investment, mathematical and science assumptions. Well, we're very fortunate with this strategy where this is the 22nd year of the operation of this strategy and we're yet to have a down year. Notwithstanding, some of the lower single-digit years we've had are in the same environments, and those environments always are equity markets that are going sideways and volatility that is low or record lows. That's where we find it very difficult to get our teeth into either the equity market or to that short-term trading market. We're trying to solve a unique problem, but it's unique to most investors in Australia, particularly retirees, where we generate income whilst still preserving and in most cases growing their capital. This is a very unusual concept, but this is what Dalton Street solves. So we've been doing this inside investment banks and family offices for over 22 years. Something that we came up with actually goes back to my career 25 years ago. I started in the aeronautical engineering field where I was involved in research and development on gas turbine engines. When most people hear that, they think that I'm trying to make these things go faster, but nothing could be further from the truth. In fact, the core element to that research and development is making sure they don't stop and plummet out of the sky. If they so happen to go a little faster on the back of that engineering, that's a great intended consequence. So I see it as no different to what I'm doing today, building algorithms for Dalton Street Capital. We engineer portfolios to make sure they don't stop. In other words, we don't lose the client capital. And as part of an intended consequence of that engineering of the portfolio, we make a good income return and we make a good capital gain return. That's exactly the outcome that most clients are looking for. So in some ways, I feel as though I'm still doing the same job I was doing 25 years ago.